My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second, we know the definition of a recession, the technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research are the unofficial but widely followed referees on when you're in a recession and when you're not. Well, we're in the 9th year of an expansion. So wait a second, how can we be in a depression if we're in the 10th year of an expansion? And the answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and a depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. As I say, we're in the 10th year of an expansion. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth with no particular tendency to collapse or getting back to trend. In other words, if trend growth, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States. You can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, 1 percentage point, who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. Here's the trend line. Here's the actual line. That wedge gets bigger. So we're 10 years out. We've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. By the way, that definition I gave, a sustained period of below trend growth, that's not my definition. John Maynard Keynes came up with that definition in the 1930s. It was good enough for him. It's good enough for me. I think it's accurate. But being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. The United States has had a lost decade from 2007. If something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic, technological, productivity, psychological, et cetera, haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan, it's true in Europe, not so true in China, but China's a special case. There's a lot of, they cook the books, maybe we can talk about that. Their 7-8% growth that they've been printing, cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, they'd be a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. It's bad if you can't afford it, it's not sustainable, you're using it as a substitute for real growth, and it's all going to crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is it looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later. No doubt that the Fed is over-tightening because in addition to trying to get interest rates back to normal, they're also reducing the balance sheet. They're trying to normalize the balance sheet. But now the Fed has a dilemma, which is what are they going to do if the U.S. economy goes into a recession? As I said, we're in the 10th year of an expansion. The old cliche, expansions don't die of old age, is true, but they do die. And history shows that it takes about 4 percentage points of cuts, 400 basis points in other words, for the Fed to get the economy out of a recession. Well, how do you cut interest rates 4% if you're only at 2%? The answer is you can't. You cut them to 0 and then you're stuck. You're at that 0 bound, and the evidence is good that negative rates don't work. So then what do? Well, then you go to QE4. We're going to print some money again. But there, if you had the balance sheet at $4.5 trillion, how high can you go before you destroy confidence? 5 trillion, 6 trillion, 7 trillion? Well, the modern monetary theorists would say, yes, I disagree, and I think the Fed disagrees, as shown by their own actions in trying to reduce the balance sheet. So what the Fed is doing, they're trying to raise rates, they're trying to get the balance sheet down so that when the recession hits, they can run the playbook again. They can cut rates and, if necessary, do QE. But here's the dilemma. Can you normalize interest rates and normalize the balance sheet without causing the recession that you're preparing to cure? That's the conundrum. I think the answer is no. I think that actually in trying to tighten to get ready for the next recession, they're probably going to cause the recession. There's no data, there's no time series that tells you how this is going to play out, except during QE, what did we see? We saw asset prices blow up, stocks, real estate, other asset categories. They all went up a lot. So it seems, at least kind of first order intuitive, that if you print money, asset prices go up. If you destroy money, asset prices are going to go down. So what the Fed is doing, they're destroying money, reducing the money supply. So they're really double tightening. This reduction in the balance sheet is probably equivalent, this is an estimate, probably equivalent to 4 more rate hikes per year. So they're actually tightening at a tempo of about 2%, probably going to throw the economy into recession. The Fed has never forecast a recession. They have a terrible forecasting record. This will happen before they know it. Of course, we all know that stocks will go down. So based on that, I'm not bullish on growth. I'm bearish on stocks. Gold is actually doing fairly well considering the headwinds. People say, well, gold hasn't gone up a lot. It's true. I'm surprised it hasn't gone down more given the tightening environment that we've described. So gold has actually performed fairly well. Now, what I do expect is in time, as the signs of recession emerge, yield curve inverts, growth slows, job creation slows down, not a full-scale recession or crash, but just enough warning signs, and the Fed reverses course that all of a sudden they do pause at one of these meetings, gold's going to skyrocket, because that's an admission. At that point, the Fed's throwing in the towel. They say, you know what? We really can't escape the room. We can't get back to normal, because when we try, we sink the economy and we have to back off from that. And that's when I think that's when gold will shine, no pun intended, because it'll be very clear that the Fed cannot get out of this easy money mode. One thing I never do, I never make a forecast or make a claim without backing it up. I mean, there are people out there that are a dime a dozen, this is going to crash or this is going to go up or growth is great or it's slow, whatever. That's fine, but you need to back that up with some kind of analytics, some kind of data, some kind of analysis that you can do. And I always do that, and I'm always happy to kind of drill down on that. So the methodology I use is quite different from what Wall Street forecasters use. First of all, I'll just spend a minute on what Wall Street does and what most analysts do, because it's badly flawed. It's no surprise that the Fed, every year the Fed does a one-year forward forecast. So in 2009, they predict 2010. 2010, they predict 2011, so on. Same thing for the IMF, same thing for Wall Street. They are off by orders of magnitude year after year. I mean, how can you be wrong by a lot 8 years in a row and then have any credibility? And again, the same thing with Wall Street. You see these charts, and the chart will show the actual path of interest rates or the actual path of growth. And then along the timeline, which is the x-axis, they'll show what people were predicting at various times. The predictions are always way off the actual path. There's actually good social science research that shows that economists do worse than trained monkeys in terms of forecasting, and I don't say that in a disparaging way. Here's the science. A monkey knows nothing, right? So if you have a binary outcome, up, down, high, low, growth, recession, and you ask a monkey, they're going to be right half the time and wrong half the time because they don't know what they're doing. So you're going to get a random outcome. Economists are actually wrong more than half the time for two reasons. One, their models are flawed. Number two, what's called herding or group behavior. And economists would rather be wrong in the pack than go out on a limb and maybe be right, but if it turns out you're not right, you're exposed. There are institutional constraints. People want to protect their jobs. They're worried about other things than getting it right. So the forecasting record is pretty bad. The reasons for that, they use equilibrium models. The capital markets are not an equilibrium system, so forget your equilibrium model. They use the efficient market hypothesis, which is all the information's out there. You can't beat the market. Markets are not efficient. We know that. They use stress tests, which are flawed because they're based on the past, but we're outside the past. The future could be extremely different. They look at 9/11. They look at long-term capital management. They look at the tequila crisis. Fine, but if the next crisis is worse, There's nothing in that history that's going to tell you how bad it can get. And so they assume prices move continuously and smoothly, so price can go from here to here or from here to here. But as a trader, you can get out anywhere in between. And that's where all these, insurance, portfolio insurance models and stop losses come from. That's not how markets behave. They go like this. They just gap up. They don't hit those in-between points, or they gap down. You're way underwater, or you missed a profit opportunity before you even knew it. So in other words, the actual behavior of markets is completely at odds with all the models that they use. So it's no surprise the forecasting is wrong. So we talked earlier about business cycles, recessions, depressions, and that's conventional economic analysis. My definition of depression is not exactly conventional, but that's really thinking in terms of growth, trend growth, below trend growth, business cycles, etc. Collapse or financial panic is something different. A financial panic is not the same as a recession or a turn in the business cycle. They can go together, but they don't have to. So let's talk about financial panics as a separate category away from the business cycle and growth. Complexity theory shows that the worst thing that can happen in a system is an exponential function of scale. Scale is just how big is it? Now you have to talk about your scaling metrics. We're talking about the gross notional value of derivatives. We're talking about average daily volume on the stock market. We're talking about debt. We could be talking about all of those things. This is new science, so I think it'll be years of empirics to make this more precise. But the theory is good, and you can apply it in a sort of rough and ready way. In other words, if you triple the system, the growth went up by a factor of 10, 50, etc. There's some exponential function associated with that. So, people think, well, gee, in 2008, we learned our lesson. We got debt under control. We got derivatives under control. No, debt is much higher. Debt to GDP ratios are much worse. Total notional value, gross notional value of derivatives is much higher. Now, people look at the BIS statistics and say, well, the banks actually, gross notional value of derivatives has been going down, which it has, but that's misleading because they're taking a lot of that, moving it over to clearinghouses. So it's never been on the balance sheet. It's always been off balance sheet. But even if you use the footnotes, that number has gone down for banks, but that's only because they're putting it over in clearinghouses. Who's guaranteeing the clearinghouse? Notice the risk hasn't gone away. It's just been moved around. So given those metrics, debt, derivatives, concentration, the fact that the 5 largest banks in America have a higher percentage of total banking assets than they did in 2008, so there's more concentration. That's another risk factor. Taking that all into account, you can say that the next crisis will be exponentially worse than the last one. That's an objective statement based on complexity theory. So you either have to believe that we're never going to have a crisis, and I'm like, well, you had one in 1987, you had one in 1994, you had one in 1998, you had the dot-com crash in 2000, mortgage crash in 2007, Lehman in 2008. Don't tell me these things don't happen. They happen every 5, 6, 7 years. Doesn't mean it happens tomorrow, but nobody should be surprised if it does. So the point is, this crisis is coming because they always come, and it'll be exponentially worse because of the scaling metrics I mentioned. Who's ready for that? Well, the central banks aren't ready. In 1998, Wall Street bailed out a hedge fund, long-term capital. In 2008, the central banks bailed out Wall Street, Lehman, but Morgan Stanley was ready to fail, Goldman was ready to fail, etc. The problem has never gone away. We just get bigger bailouts at a higher level. What's bigger than the central banks? Who can bail out the central banks? There's only one institution, one balance sheet in the world that can do that, which is the IMF. The IMF actually prints their own money. The SDR, the special drawing right. SDR is not strawberry daiquiri on the rocks. It's a special drawing right. It's world money. That's the easiest way to think about it. They do have a printing press. And so that will be the only source of liquidity in the next crisis because the central banks are not, if they don't normalize before the crisis, and it looks like that they won't be able to, they're going to run out of runway, and they can't expand the balance sheet beyond a small amount because they'll destroy confidence. Where does the liquidity come from? The answer is it comes from the IMF. So that's a kind of global monetary reset, monetary apocalypse getting worse.